Chiwon Young will talk about bank entrepreneurs. She's a senior economist at the Center of Financial Research, with the Federal Deposit Insurance Corporation. She dedicated her career to evaluating bank performance and risk measurement, new bank formation and entrepreneurship, and how relationship lending contributes to credit availability. Without further ado, Chiwon, the stage is yours.
Thank you, Elena. And thank you to the organizers for accepting our paper. It's great to be part of this conference, and I look forward to your new insights and your suggestions on how to make this study better. This is joint work with Christoph Kleiner at Indiana University, Manju Puri at Duke University, and I do want to say all the analysis, conclusions, and opinions that we present here are of the authors, and they don't necessarily reflect the views of FDIC. So we know that banks are important, and they play an important role in supporting economic growth through corporate investments, employment, entrepreneurship, and innovation. As a result, there's a lot of research that has looked at development of new products, expansion to non-banking, monopoly and competition, mergers and acquisitions, and failures that have really expanded and enhanced our understanding of banks. What we don't know too much about is where do banks come from? And one of the reasons is really the data limitations that has made studying this topic more challenging. But it's an important question that can inform us on what motivates bank creation and entrepreneurship. And to the best of my knowledge, our study is the first analysis of bank entrepreneurs. So the methodology that we use is we create a new data set that's derived from Section 5 of the FDI Act, which requires any institution seeking deposit insurance to apply to the FDIC. Through this application process, we observe detailed information on potential de novo banks, areas such as their sources of financing, their earning prospects, their capital adequacy, lending strategy. We also have detailed biographies of all founding members, as well as interviews with these entrepreneurs, providing their reasons for starting a new bank. So our first contribution, we illustrate how banks are chartered and who charters them. Then we match these approved applications to their future call reports to look at their lending strategies and their performance. So our second contribution is we relate bank entrepreneurs to the lending strategies, performance, and survival of these banks. So we take a sample of 185 banks that were chartered between 2000 and 2008, and we hand collect information from the application to compile our data set. We define our bank entrepreneurs as bank's CEO and president, directors, and chief officers who invest capital in the firm, as well as shareholders who invest more than 10% of bank's total equity. We also have information on these individuals, including their employment history, their net worth, and how much they invest in the bank, their age, and where they reside. So we have information on roughly 1,900 individuals. I'm going to skip some of these. So the first question we ask is, where do banks come from? So we find that the median de novo banks are chartered with 11 entrepreneurs, and 5 of them have experience in banking. The entrepreneurs have a median net worth of $3 million, and the entrepreneurs as a group invest 22% of the total equity raised. The median age is 52 years old, and they live in local area. The distance between the bank headquarters and their residence, the median value is 7.5 miles. We also, through our application process, we're able to see what their motivations are for starting a new bank. And 56% have given reasons that are locally focused. So they would say that reasons such as we want to start a locally owned bank with local decision making. 34% mentioned wanting to offer better service to their customers. So we see sort of the two primary reasons for starting a new bank are really the qualities that characterize community banks. The remaining reasons were pertaining to market growth and merger activities. We also look at the professions and employment history of these entrepreneurs, and we find that 95% of the banks in our sample have at least one entrepreneur who has a full-time employment at a bank. If we also include ones who served as directors, this is 100%. So we notice that all entrepreneurs sort of include at least someone who knows banking, which is very consistent with sort of banking being really a specialized skill. You need to know how to do banking to start a bank. We also find that a lot of other professions among entrepreneurs are people with real estate experience in sort of medical doctors and dentists, CPAs, attorneys, and business owners. So sort of the common denominator across all these professions are really, they have a large network of contacts, whether they're patients, whether they're clients or customers. And we think this is important so that they can bring these customers to the new bank. 58% of the interview comments include statements like, I have many contacts to refer to the bank for deposit or credit services. We also find that majority of the bank entrepreneurs come from smaller banks. 51% come from banks that are less than 500 million in assets. Overall, we find that regardless of the size of the bank that they come from, they tend to have managerial experiences. They are president or CEO or director in smaller institutions, but they also tend to hold positions such as branch president, regional president from larger institutions. Okay, so the second question we ask is, how do these entrepreneurs influence bank performance? We've seen earlier that 95% of these banks include at least one entrepreneur who has experience in banking. So we apply the instrument of variable strategy where we show that lending policies of their prior bank predict performance of new banks. And this is consistent with earlier studies that have shown that manager experiences predict corporate policy and performance. And we use CRE lending as our primary source of risk exposure. So our strategy is basically, we ask, okay, is the de novo bank's lending strategy, can it be predicted by the experience of the entrepreneurs? And if yes, can that also impact their performance? So first, we're going to see whether their lending strategy can be predicted by their prior experience. What we find is that if the entrepreneurs came from banks that had higher C&D loan ratio, the de novo bank is also likely to have higher C&D loan ratio. That pattern is observed for CRE loans, residential real estate loans, C&I loans, and consumer loans. That is observed across all these different types of loan types. So what we do is the variation in lending strategy that we could isolate as coming from their experience, we're going to isolate that variation, and we're going to see if that can predict these banks' performance during the financial crisis. Okay, so we find that that portion of variation coming from the experience of the entrepreneurs is what we're calling instrumented CRE. So we find that these banks with higher CRE loan ratios experienced a larger decline in their equity ratio between 2000 and 2010, larger decline in earnings ratio, larger increase larger increase in non-performing loan ratio and larger increase in loan charge-offs. When we use instrumented construction and development loan ratio, we find very similar results. We also find that banks with higher instrumented CRE and C&D loan ratios were also more likely to fail during the crisis. So to conclude, we asked 2 questions in this research. First, where do new banks come from? We find that bank entrepreneurs are mature individuals with experience in banking and real estate who live near the bank and have many work-related contacts. They come disproportionately from small local banks, and local focus and customer service are the top 2 reasons for organizing new banks. And over 20% of the bank capital comes from the entrepreneurs. We also asked, how do these entrepreneurs influence bank performance and survival? We find that lending strategy is predicted by their prior experience, and that instrumented lending strategy can explain bank performance as well as the likelihood of failure. Thank you.